It's been another volatile day in the markets with crude oil bouncing around on mixed headlines about the US-Iran deal. Hi traders, Fawad Razaqzada here, market analyst with StoneX. Markets started Thursday in a slightly better mood following Wednesday's big rally, but that optimism faded pretty quickly once oil prices turned higher again. Crude prices rose on reports that Iran's supreme leader has ordered that the country's uranium must remain inside Iran. Now, whether that report turns out to be true or false and what it might mean for the ongoing talks remains to be seen. But with oil rebounding, bond yields rose and downward stocks. And that really sums up the recent market trend, mixed messages and a lot of uncertainty. Everything remains heavily dependent on what happens next in the Middle East, making this a headline-driven market. Now, if we do eventually get a deal between the US and Iran, you'd probably see a strong rally in European stocks and potentially a more moderate move higher on Wall Street too. But the longer this stalemate drags on, the bigger the risks become for global growth and indeed stock markets, mainly through higher energy prices. What's also interesting is that even Nvidia's latest earnings results failed to lift sentiment. Under normal circumstances, results like that would inject serious momentum into equities. But at the moment, oil prices are dominating the narrative, driving the near-term S&P 500 outlook. Now, alongside crude oil, bond markets are becoming increasingly important as well. The US 30-year bond yield briefly hit 5.2% on Wednesday, which is the highest level since 2007, before easing slightly. Global yields remain near multi-year highs as well, and further gains there could put lots of pressure on equity markets and indeed other risk assets as well. Now, only a few months ago, investors were convinced inflation was cooling and that the Fed would cut rates eventually, but rising tensions between the US and Iran around the Strait of Hormuz have completely shifted that outlook. What's been remarkable, though, is just how resilient US equity markets, especially technology stocks, have remained despite the rise in bond yields. The S&P 500 has only recently pulled back from record highs, even as borrowing costs have surged higher again. But that resilience could now face a tougher test. If yields continue climbing, then pressure on high valuation growth stocks is likely to increase, raising the risk of a broader correction across equity markets. From a technical analysis point of view, the trend in the S&P 500 is still constructive, but momentum is clearly beginning to cool. The market has spent the last week trading sideways rather than pushing aggressively higher, which suggests that investors are becoming more cautious near these elevated levels. Support comes in around 7,380, which is the initial level of support. Then stronger level is seen lower down near 7,300 and then 7,200 if the selling pressure accelerates. Meanwhile, on the upside, traders are still watching that 7,500 region closely, while last week's high near 7,540 remained the next key resistance area to watch. For now, though, any weakness still looks relatively contained. A much larger correction would probably require another sharp rise in oil prices, as well as bond yields and a further escalation in US-Iran tensions. Thanks for watching. Don't forget to like this video, and if you haven't already done so, subscribe to our YouTube channel. Take care, and I will see you in the next update.